Well, what is going on, guys, and welcome into the video. Well, we have the CPI release coming Thursday, and it will dictate the movements of stocks over the next month and will absolutely determine the course the Fed takes next. Basically, this number will determine if we get the beginnings of a rally or if stocks make another leg down, and honestly, it could be brutal this time. So let's discuss that today and exactly how to handle this possible destruction or big run in your stocks. I just ask that you hit that like button, and if you aren't subscribed, click that subscribe button now and turn on notifications. Even if you are subscribed, make sure you have those turned on, otherwise YouTube is dumb and won't show you my videos, even if you're subscribed. So everyone outside of this guy knew that inflation was coming, and man, did it ever hit hard. And as you can see here, it just continued marching up until March, and then somewhat kind of leveling off for 3 months again before trending back up in June. And we saw that exact pattern before, as we saw it hover around 5% for 5 months or so last summer, before starting to march up from there to over 8% that we are seeing so far now. We may have hit that inflection point last month, maybe, I'm not real sure here, but we need to see inflation continue to move down to actually reverse the trend. But given that the Fed just now started getting aggressive with rate hikes this summer, and those hikes typically take months and sometimes longer to show up in the inflation data, I don't think the rate hikes have had the effect to stave off inflation so far, so we could see if this flattens or even continues to march up before the hikes start to actually take effect, and that honestly could spell disaster. And that's basically because the Fed has been so far behind the curve that they're basically going to be behind again if that actually happens. Last month's number was down, but not down to where the consensus estimates were, despite energy prices declining significantly. And honestly, guys, that's a problem to say the least, because many were thinking there was a possibility of a 7 at the front of that number, and it just didn't happen despite energy prices coming way down. Add in the fact that rent has continued to trend up, now not as aggressively as before, it is starting to slow, but it is still trending up, along with food remaining elevated and trending up. It seems clear to me that the number was not going to come in as low as expected. But this month could finally be the inflection point we need to start seeing that number kind of start to inflect down, or at least flatten and then start to move down. We had several earnings calls last quarter mentioning the cost of raw materials are coming down and finally starting to hit their bottom lines. And we are seeing folks like Elon saying he thinks inflation has peaked as well, and he is involved with multiple companies that use a lot of raw materials and were impacted strongly by the massive rise in prices. And kind of just looking across the data overall, you see stuff like lumber and other commodity prices all plummeting, and you have shipping costs to continue to decline by like 80% or something crazy like that, and other costs are all moving in the right direction as well. Unfortunately, the ridiculously hot jobs market will allow the Fed more headway to continue to stay aggressive. They are actively trying to create more unemployment, and so far they've not been successful at all. If we could just get that number back to normal, it would really help the inflation fight. And don't worry, if it goes into the 4s, which is where it should be during normal times, that's 4 to 4.5% is kind of that natural rate of unemployment that we need. The YouTube and media freak out about mass layoffs and unemployment, doom and gloom, worse than the Great Recession. Maybe even the Great Depression is absolutely coming, despite the fact we're just back to the normal rate of inflation. Again, the Fed is actively trying to create more unemployment, not increase employment like they did in 2009 and moving forward. So basically talk to me when we see a 6 in front of that unemployment number, as that is when I will get concerned. But I just kind of ruined a good fear video for someone out there, good fear narrative or whatever the heck's going to come out there whenever it hits, 4% and we're hitting all these crazy mass layoffs and all the rest of that garbage. This CPI number is the first of 2 catalysts that will set the stage for the next quarter, with the other being earnings season. Now, I just released my earnings report for this upcoming earnings season to my private group that will get them primed and ready for what is coming this earnings season, what to watch for, what insiders are expecting, and how the market will react to a bunch of various scenarios. And honestly, because I forgot to take down the sale on my website, I just extended it through this weekend for you guys out there to jump on if you want my earnings season report, or if you want to take 5 courses for free and get on our live weekly Q&As where I answer any question about anything and we get deep into a lot of various topics. It's my favorite part of the week by far, so check out the pinned comment if you're interested in becoming a member and get the sale price for as long as you stay a member too. But that expires this weekend for real this time, because I wrote it down and I'm not going to forget it. So really, there are 3 scenarios that will play out, and I will discuss what I am doing specifically in each of those scenarios. So let's start with the positive one first, and that is we see it finally inflect down into the 7s. Now, hopefully not down too much, because all that will do is have everyone not believe the numbers or just create more conspiracy-driven narratives around it and all that other stuff like that. But if we get down into the 7s, the table will be set for a nice rally to end the year on. The reason for the rally is because Wall Street will think the Fed will slow down or at least start acknowledging the plan is working if the reading comes in that range. Now, it's too early to declare victory and not enough of an inflection down to stop the rate rises altogether overall, so please don't fall for that narrative either like many did on the last big rally that we had. But Wall Street will start to trade, assuming the Fed won't hike us into oblivion like it's already out there. In this scenario, I will continue to buy stocks as they hit my price targets and continue my modified DCA. It seems to be a different stock that I'm buying every week, so I will continue to be a buyer, but not as heavy as I was back in June or the past couple of weeks that we just had. That was the time to go wild and buy big, but that doesn't mean you missed out completely either. The deals are still great on many stocks, and I will continue to be a buyer. But the second scenario is we see it really inflect down. And if that's the case, Wall Street may accelerate and really push stocks up as they start to speculate on the Fed actually not being as aggressive and potentially stopping soon altogether. That will absolutely drive that narrative crazy. The market hates uncertainty, but in this case, the uncertainty moves towards the Fed current plan being the worst case kind of scenario, with a chance that it will get more dovish towards the end of the year and the markets will rally big on that. And in this case, my strategy is the same as the first scenario. I will just continue executing my buys at my price targets, but I will not get caught up in any FOMO like many did in August and September on that huge rally. I think the Fed will stay more aggressive than Wall Street thinks, and so the rally will inevitably correct back down. Now, maybe not down to new lows, but the rally will pull back and it will be over aggressive when it does that. And lastly, we have inflation coming hot, like well over 8.5%, then the market will not wait for earnings at all to completely sell off. They will immediately start to sell stocks because we all know that not only will the Fed continue to be aggressive, they might either be more aggressive at the next meeting than the expected 0.75% rate hike that we already expect that they're going to do. So it'd be, closer to that 1%, or at least that's what everybody would speculate it would be. This is going to induce strong selling pressure into the markets. Now, probably not as bad as the media or YouTube will make it out to be, but it will create big selling pressure in the markets once again. And in this case, I will do two things. One, I will still be buying, but I'm going to be selective, as when we have a big fear event like this, the VIX will spike and the sell-off will often last a lot longer than a day or two, so you have time to be patient. In this case, patience will bring more stocks not only into my target ranges, but into the lower parts of those ranges, and some may even hit stupid low territory again or even lower. So in that scenario, I will buy as much of the fear as I can during that time. This is where planning is the absolute key. Just think about way back in May or June or so. It was very easy to be buying hard during that time, and then it was easy to be patient and not FOMO into the rally that followed, but instead you were pooling as much cash as possible for an opportunity like this, and this is exactly what we preach in our group too, doing evaluation, setting price targets, buying the fear and being patient and saving and working to put away cash for the next opportunity. When the market rallies a little bit, that's the time to kind of stack up your cash. And then whenever all the fear and all the other junk that comes out and everything else is coming down on you, that's the time you start to deploy that cash and basically kind of rinse and repeat the strategy. But let me be very clear here too. If Wall Street wants to get stupid again, please let them. The average bear market lasts 289 days, and we are well into a bear market now. And by the time it flips and the numbers look good and you have confirmation that the bear market is over, we are already in the middle of the next bull run. So I will not let opportunities pass me by waiting for this indicator or that indicator or anything else. Just like during the financial crisis, I will be buying the arrows on this chart because nobody can time the bottom. It's not even worth trying. Absolutely nobody can do it. Hate to bust the bubble here on YouTube and in the media of smart folks out there, but there is no indicator or formula that tells you when that is, so it's absolutely useless to try to time that event. Put yourself in a spot where no matter what happens, you are in a win-win position as a long-term investor. So hopefully this was helpful. And if you don't know how to get a price target or how to do evaluation and want a step-by-step process for doing that, building wealth, and you want direct access to me and much more, remember to check out the pinned comment down below to become a member and at least look at everything you get. And click this video here for the stocks I'm still buying in this market, and click here for exactly what I'm doing to make huge money in this market. So thanks for watching, and we'll see you in the next one.